Okay, and for our portion, for USI research, we put our focus on Philippine equity building on Mr. Herrera's assessment of the current and economic times tailwinds and headwinds as we navigate our way through the uncertainties amid the turbulent start to 2022. And building on what Mr. Herrera's mentioned, the PSEI for the first quarter of 2022 has so far been volatile, with the downside driven early in January by the surge of COVID-19 infections due to the Omicron variant in early January, and more recently by the Ukraine-Russia crisis and the US Fed's decision to raise interest rates, causing volatility in the rest of the global markets as well. The headwinds have been counteracted with much effort on optimism of the country's economic recovery trajectory, as indicators have shown that we begin our transition from a pandemic environment into an endemic one, which points to a reacceleration of consumer and business activity with the first hurdle to achieve pre-pandemic levels. In relation to regional markets, the PSEI have remained buoyant alongside emerging markets on the ASEAN region, while developed markets are less attractive in view of higher sensitivity to the rising interest rate environment, as what Mr. Henry Herrera has mentioned. Um, the PSEI, so prior to the rotational outflows brought about by the US Fed's announcement to hike policy rates, the PSEI was among the top four in year-to-date return alongside Indonesia, Thailand, and Singapore. And in relation to what Mr. Henry has said, uh, out of a focus of emerging markets, through the first quarter of 2022, we have observed semblances of a focus on the TIPS theme, the Thailand, Indonesia, Philippines, and Singapore. That was a strong theme among international investors at the start of the bull run cycle of 2013. This bodes well for the PSEI in the coming quarters as the Philippines reemerges from the pandemic's economic recession. Currently, the primary headwind on the Philippine economy is the surge of oil prices to elevated levels, primarily driven by the Russia-Ukraine conflict and its resulting effect on inflation. As Philippine businesses scramble to recover lost ground and opportunities, the elevated prices of oil threatens to compress already pandemic tattered margins and the outlook of healthy consumer spending as consumers' income allocations become redirected to fuel costs. However, with so far low inflation leading up to February 2022, we do have some elbow room to effectively manage inflation. Further, the BSP has given guidance on the sensitivity of Philippine inflation to oil prices. At 95 US dollars per barrel levels, domestic inflation would be at 4%, still within the range of the BSP's target. At 120 US dollars per barrel, it would be at 4.4%, and at 140 US dollars per barrel, it would be at 4.7%. Latest BSP forecast estimates 2022 inflation to be at 4.3%, and that points to consideration of oil to be at 120 US dollars per barrel, where we see oil now to be currently stabilizing between 110 to 115 US dollars per barrel. Fortunately, as the US revealed surprise inventories, OPEC Plus countries striving to meet demand, and the prospect of China's economic slowdown to ease the demand of crude oil prices have retreated from its 14-year highs. Overall, we do see the heightened oil prices to be transitory. The initial rise in oil prices have been largely driven by world economies scrambling to jumpstart economic recovery efforts and simply exacerbated by uncertainties brought about by the European crisis. As these headwinds in world economies balance out, we will see oil prices ease back down to rational levels. In our figure below, we have tracked household consumption to have achieved pre-pandemic levels at the peak of mobility in December 2021 and January 2022, which also peaked above pre-pandemic levels as well. Retail foot traffic, the green line, has so far recovered and outperformed pre-pandemic levels during the height of the holiday season. Increasing mobility has been translating into increased household consumption, as you can see on the yellow line, last year in 2021. And we expect that trend to continue in 2022, spurred by the continuing slump of COVID-19 cases, whose trajectory we see to be downwards as the government's inoculation efforts continue. Consumer retail segments of the listed property sector are beneficiaries of this correlated trend. Names such as SMPH, Ali, RLC, and MEG come to the forefront. And in effect, next in line to benefit would be consumer food service, such as pizza, Maxis, and especially JFC. Further, as headwinds on oil and inflation ease and lighter mobility restrictions with the prospect of alert level zero, consumer manufacturing would also benefit from the out of home consumption. Names on this matter would be URC, Monde, FB, EMP, DNL, and other consumer manufacturing brands. In relation to the consumer retail segment of the property companies we mentioned, the residential segments of these companies are also in a recovery and growth trajectory. Real estate demand showing visible signs of recovery with a rebounding GVA, or the contribution of real estate activities to the GDP, sustained increasing loan take-up for real estate activities despite the pandemic as borrowing costs were low, and higher residential property prices by the end of 2021 sets the stage for a recovery and an opportunity for strategic growth for property companies. For consumer manufacturing, input costs puts pressure on the margins for the rise in prices of input commodities. These were first driven by the pandemic exit recovery efforts by world economies at the start of the year, then exacerbated by the global supply chain disruption from the Russia-Ukraine crisis. As the recent surge is driven by conflict, of which global pressure has been mounting to end it. Our view is that overall, the surge is rather transitory and would normalize later in the year towards 2023. As such, the battering of URC and Monde with regards to its stock price, we see as good buy opportunities for investors with a long-term perspective. In the power sector, the economic reopening efforts of the country will drive increased power demand for 2022. We like power for its resiliency as it's withstood the pandemic shocks and with the ability to pass on input costs to consumers amid heightened oil prices, although at a rational rate. The freedom of mobility under Alert Level 1 will drive increased power demand in commercial and industrial segments, where we already saw an uptick in 2021 amid ECQ lockdowns and Alert Levels 2 and 3. And the summer season and the election-related power consumption forecasts the highest peak demand in 4 years, where both distributors such as Meralco, transmitters such as SGP or Synergy Grid Philippines, and Gencos such as AP, CREIT, and FGen will benefit. With the global perspective of COVID-19 shifting into an endemic disease, propped with the country's increasing vaccination rate, businesses and schools are planning to revert to face-to-face arrangement with increased capacity, and this improves economic activity as well as power demand, especially in the commercial sector. And with the broad economic recovery efforts, a need for funding for consumer needs and for commercial capital requirements for capex, working capital, and other general corporate purposes, we have the banking sector. 2021 has already shown a glimpse of recovery of loan demand as NPLs have also eased. We have also seen the unwinding of loan loss provisions. In our communications with the big three, BDO, BPI, and MBT, they have noted that the use of proceeds for loans applied for commercial purposes have started to shift from a conservationary stance to expansionary use. Here, we present the loan books of the big three, and we especially like BDO for having been able to grow their loan book, although just at a slower pace amid the pandemic where other banks experienced a decrease. Where we also see growth for the banking sector on top of the return of loan demand is that banks are beneficiaries of a rising interest rate environment, as higher lending rates will translate into the recovery of net interest margins and net interest incomes of banks. While we hope that the interest rates do not hike at an unreasonable pace in response to global factors that could curtail loan demand, a reasonable rate of increase will benefit both the banks in terms of profitability and borrowers in terms of the ability to sustain loan demand. And as the leader in 2022 year-to-date returns on a sectoral perspective, we would like to note that the mining sector has strongly benefited from the global demand-supply gap brought about by reopening economies, the Indonesian export ban on coal, which directly benefits Semirara or SCC, and the Russia-Ukraine crisis that has driven up the latest surge in metal prices. Domestically, the lifting of the ban of open pit mining has also boosted prospects on the sector, as open pit mining allows for easier extraction of mineable resources, translating into lower cost margins, and the current opportunity to be able to export these out at the heightened global metal prices. These factors benefits names such as nickel, FNI, PX, Mark, and AT. For 2022, we forecast the PSEI levels to hit 8,260 points, as we expect corporate earnings to increase by 15% in 2022. With consideration to the current headwinds and tailwinds for 2022, an up and down range of 3% between our expectation of 15% implies a range of 8,000 to 8,500. On the key catalysts, our tailwinds are being validated with regards to further reopening of the economy and resulting improved business and consumer confidence as the IATF downgrades to alert level 1. Another key catalyst is the achievement of herd immunity by the end of the first half of 2022, which would further improve the Filipinos' confidence to return life to normal and the economic activities that it denotes. The increase in election-related spending in the first half of 2022 will most likely be pronounced this second quarter of 2022. The stimulus of enacted bills specifically create is a solid tailwind for the economy, as companies have been reporting improved net margins generated from tax savings from the bill. On the amendments to the PSA, RTL Act, and FIA, as earlier mentioned, foreign response may be spurred by foreign investors exiting Russia and hedging risks in the European continent, and may lead to a deployment of investments in the Philippines. And for our clients who would like to show, we would like to show several baskets that we have prepared for investors who would like to invest with a diversified approach. We have created and weighted a defensive and conservative basket, a basket that balances growth and conservation, and a growth geared basket in line with your preference of risk. Our defensive basket is comprised of REITs, with the prospect of reasonable growth in value from the growth in weighted earnings per share, but more importantly, focuses on yields as guaranteed returns on an investment. And for our basket, our weighted dividend yield for 2022 would be at 5.3%. We also have a balanced basket that prospects outperforming the PSEI's corporate earnings growth of 15% by 16.1%, and a relatively attractive dividend yield of 4.0%. How we crafted this basket is that we did mix growth stocks along and with defensive stocks of REITs to give a good amount of return, but still maintain a good dividend yield to allow for a defensive nature for the portfolio. Lastly, for investors who are geared towards capital growth, we have a growth-oriented basket weighted to outperform the PSEI's corporate earnings growth of 15% at 28.5%, while maintaining a dividend yield of 2%. For those interested and have any questions on our baskets, we invite you, our clients, to meet with us to allow us to discuss in detail and adjust accordingly in line with your trading strategy. Lastly, for investors who are interested in investing in just one or two stocks for the year, here is our top 5. Our first one is AC, and we like AC's exposure in strong rebound sectors in property and banking, along with sustained demand for power and logistics. As pseudo-economic trackers, the broad economic recovery will benefit conglomerates and will track the growth of its subsidiaries, with most listed companies on a recovery trend. Next, we like Ali. So strong demand for its residential properties and improving construction activities will sustain the robust growth of its residential segment, and the further easing of mobility restrictions will benefit its mall and hotel operations. Next, under property is SMPH, and we like SMPH for its high exposure to commercial and retail space, with SM malls capturing the recovery story. The improving consumer confidence to go out and spend will help drive higher foot traffic for mall visits. Next is under power, which is Meralco. We like Meralco for that energy demand is seen to rise following the summer season, the easing of quarantine restrictions, the return of employees to their office workplaces, and the election-related activities. We expect demand in the commercial segment to continue to recover. And lastly, in the banking sector, BDO. Of the big three, BDO, MBT, and BPI, BDO stands out by having the largest commercial loan book. As such, the outlook of rate hikes in the coming quarters will benefit their net interest incomes the most. And here, should you consider investing in our top five as a basket, simply weighted according to its market cap, corporate returns, if invested in a basket, is estimated at 36.8% and with a dividend yield of 1.2%. Lastly, for everyday guidance as we weather volatility this year, here we show our PE sensitivity between the 6,000 to 7,500 levels. Highlighted in green are established support and resistance levels in the past year. Gold is today's close of the index. What we would like to highlight here is that at the current level of 7,200 points, the 12-month forward PE is at 16.7 times and is actually a very good time to accumulate for investors with a long-term view, as the PE level is at a negative 1 standard deviation and at a substantial discount from our 10-year historical average of 20 times for the 12-month forward PE of the PSEI. In summary, as we navigate our way through 2022, we note the following notes to keep in mind. The Philippines is poised for domestic economic recovery this 2022. The easing of COVID-19 pandemic and downgrade to alert level 1 prompts clearer skies for our economic recovery trajectory. The next is with the US equity outlook weakening due to the rising interest rate environment and uncertainty in European equity due to Russia-Ukraine crisis. Rotating funds out of these regions may flow into emerging markets, with the Philippines included. A key metric to monitor moving forward is inflation, as it will, one, set the tone for the central bank's actions in response, two, determine economic areas heavily affected by the current headwinds, and three, influence the pace of broad economic recovery. Other catalysts to monitor are, one, the end of Russia-Ukraine conflict. Two would be the easing of crude oil prices to at least $100 per barrel. And three, China's ongoing surge of COVID-19 cases, which has led them to shut down several key factory cities, as well as most recently, their financial hub of Shanghai. And in view of these other catalysts, in our view, these other catalysts are transitory. And as these headwinds alleviate, these would be positive catalysts that would reinvigorate optimism in the Philippine equity markets. From a fundamentals perspective, while the market sentiment and consideration of the headwinds create significant selling pressures, valuations are currently attractive. And as the situation's changes progresses at a rapid pace, we expect volatility in the coming months. As such, dips may present discounted buy opportunities relative to expected fair values driven by economic recovery perspectives. Lastly, in managing your investments, we believe that clear investment objectives complementing risk profiles are the best approaches amid challenging times. And with that, we thank everybody for our portion. That is it for our market outlook and strategy. And before we go into our Q&A, we would like to call on our President and CEO of Unicapital Securities Incorporated, Mr. Toby Pañares, to help us wrap up our takes and share his wisdom on how investors can best manage risk and make good investment decisions during these challenging times.
Thank you, Gab, and thank you, Henry, for the outlook as well. And I also want to thank all our attendees for sharing the time with us and this afternoon. I hope you found the information shared by our speakers insightful and should be able to help you as well in each of your own investment decisions. As we come to the close of this webinar, the question I want to ask ourselves as the investors is, given what we heard, what should I do, right? What should I do now with my investments? So let me recap a few points made by the speakers, learnings that I saw. Best performers does not necessarily mean they're going to be the next better performance the following year, right? Earnings outlook is good for banks, property, etc. this year. And I think that is going to be the way it would be, regardless of who the winning presidential candidate might be, right? Stocks are favored over bonds. So the most important thing, I think, is decision needs to align with your investment objectives. There's so many risks. There's so many things we'll always be worried about. The global debt crisis, the inflation, the interest rates going up, which will impact, obviously, your investments. Um, so if we keep on thinking about these risks, we will tend not to do anything, which I think is one of the first things that we should try to avoid. Because one thing is clear, there is no perfect investment. That I can tell you. If there was one, we'd all be there. And Gab, myself, and everybody in investment world would not have a job anymore because everybody will be in that particular investment. The thing is, there's none. But what I can tell you as well is there is always one that will make the most sense, depending on what you are investing the funds for. We can help you make those decisions. We don't have the time to explain each and every one of them for you. But bottom line is, do not invest, obviously, your emergency money on stocks because you don't want to be pulling it out when it's down. History will also show to us, as has been mentioned by the speakers, that over time, over a long extended period of time, stocks have always done better. There's always worry. This year, they said the most worrisome is inflation, especially in the US, and the interest rates going up. Now, that tends to now make people say, so I'll just hold on to cash. Maybe I'll go to some gold. Maybe I'll go to some other assets. But we tend to not act on what it is. I read one time one of the financial experts say, the best time to invest the money is when you have the money. When you already have fulfilled your emergency requirements, your cash reserve, then you just invest it. But the key, again, is to invest it in what would make the most sense for you. And that we could help you with. And let me end this with a story. I promise to be brief. In 1994, because this reminds me, this worry right now reminds me of 1994 in the US. I was still starting in my career in the investments. I've been a few years into it. Everybody was saying this is not going to be a good year. Interest rates will be raised so many times. And true enough, that actually happened. And so people were not, don't go to stocks, don't go to bonds, etc. At that point in time, I just invested money in a mutual fund, which is invested in stocks. Now, people would probably say, well, why'd you do that? You knew the funds were, you know that it probably will go down. My point was, I'm investing this for my daughter's college education, which would be 18 years from now, because she was born November 1993. And true enough, the experts were right. Inflation was up, interest rate went up 6 times with almost 100 basis points rise in the last interest rate that the Feds did. And the bond market was really in a bad shape. Although I think, if I remember it correctly, the stock market still went up by 2%. The value of the fund that I invested in, and let's just say it was $100, became $70 that end of the year. So the thing is, I did not sell, so I didn't lose the money. When I did sell it 18 years later, it was 5 times the value, and it helped me pay for the education, or the tuition, I should say. So why am I telling this story? Bottom line, you gotta invest in an investment vehicle that will achieve the objective that you're trying to do. You don't want to buy stocks because people say that it's gonna do well. You gotta look at it, understand it, look at the valuation of it, etc. And I know God and our team has provided that. active traders as well, you're being guided by Kiko on that as well. So bottom line is understand what you're investing the money for. And I think you will find that you have a good investment vehicle to go with it. And with that, I want to thank everyone for attending, and I believe it's time for the Q&A. Thank you, everyone.